Sean, what kind of advice would you give a high net worth individual evaluating triple net properties?
Well, this is a very interesting market for both buyers and sellers. We deal exclusively in net lease properties and very often credit tenant properties that have an investment grade rating. The cap rates have compressed pretty dramatically in the last couple of years, and we are really struggling right now on behalf of buyers to secure properties that have a risk-adjusted return. And you may ask, well, what's a risk-adjusted return? Well, we had a property yesterday that was a build-to-suit right out of the ground, a brand new property in Florida. Starbucks was a tenant. Starbucks was proposing to pay, based on their lease contract, $110,000 a year, and it was being priced at a 5 cap, which is in the range of acceptable for this kind of an asset in this kind of a market. Well, we dug a little bit deeper and said to the client, this is located in a tax-free state of Florida, so that's a plus. It is at a cap rate which is consistent with the current market, but traditionally Starbucks have paid something in the range of $75,000 to $80,000 a year. So why would this particular Starbucks pay more? And the answer is we have to check with the Starbucks real estate folks to verify that and why they did that site selection. But for our purposes, we looked at this location to say, is this a location that's going to be worth more in 10 years or less than 10 years with or without Starbucks? So our conclusion was that if you bought this on an unlevered basis at a 5 cap, you've got a 5% return, which is a halfway acceptable return in this market with investors chasing yield. But if in fact Starbucks were not to renew, you might not achieve that kind of income in 10 years. So this is a case where the property might literally be worth less in 10 years rather than more in 10 years. And real estate by nature is a hard asset, it's an illiquid asset, and the presumption is, are you buying something with good, strong residual value that you could release if you had to, or are you simply buying for short-term yield? So this is one of the debates that investors are having in this market. I think we can guide them through this kind of a process very effectively and basically help make the best decisions available in this net lease market.